Nearly 1 in every 17 homes listed for sale in America was pulled off the market last April. Not sold, not under contract, just gone. The sellers who pulled them are still sitting on those houses, still paying the mortgage, still waiting. They are not investors flipping speculatively. They are not distressed borrowers being foreclosed on. They are ordinary American families who bought a house during the pandemic, watched its value climb, and made a plan around a price the market no longer agrees to pay. Working couples in Atlanta's suburbs, retirees in Austin who thought they would downsize this spring, families in Memphis who circled a school district and put their old house up for sale. You have probably driven past one of them this week without knowing it. A for sale sign in the front yard in March. Gone by June. No moving truck, no new neighbors. The same family still eating dinner in the same kitchen, only quieter about it now. That is the American housing market this summer. And the number behind it is among the strangest housing statistics in a generation. Here is the figure. In April, 5.8% of every home listed for sale in the United States was pulled off the market by the seller before it sold. That ties December of 2025 for the highest delisting share since March of 2020, the month the pandemic froze everything overnight. Redfin's own analysis of MLS data puts it plainly. Before 2020, delistings were never this common. Not in a normal year, not in a bad year. This is a structural record, not a blip. In May, the rate barely moved, 5.5%. Still a decade high for that time of year. On a seasonally adjusted basis, April delistings were up another 3.8% from March, the second month in a row they climbed. Now listen for the part that doesn't fit. Inventory is rising. There are more homes for sale in America right now than at any point since the pandemic. About 1.1 million listings, according to Realtor.com. Nearly double what was on the market in the summer of 2023. And yet sellers at record rates are pulling their homes off that same market rather than competing on price. More homes for sale. More sellers giving up. Both true. At the same time, that is not what a normal downturn looks like. In a normal downturn, sellers cut price. Buyers eventually bite. Inventory clears. What is happening now is different. Buyers have lost their fear of missing out. Sellers have not lost their memory of 2022. And the gap between those two rooms is where the American housing market is stuck. Look at Atlanta. In April, 10.7% of the homes listed for sale in the Atlanta metro got yanked off the MLS, according to Redfin. More than 1 in 10. Among the highest delisting rates of any of the 50 largest metros in the country. Not because a wave of buyers scooped them up. Because the sellers looked at the offers coming in and decided they would rather sit on the house than take the number. A Redfin Premier agent working the Austin market describes what that looks like across the kitchen table. Many of the sellers who pulled their homes last year did it, she says, because they had not yet found their next house. There was no destination waiting. Without a destination, there was no reason to lower the price. So the sign came down, the listing disappeared, the house waited. Now those same sellers are circling back. And the calculation they are doing is not surrender. It is math that works in both directions. The number they accept on the house they leave is the number they save on the house they buy. The story does not stay in Austin. There is a homeowner in her early 50s whose monthly payment is a number she has memorized, a number that would balloon by more than $800 a month the moment she moves. There are 4 days in late February when the rate boards flipped to 5.99%, and a single event overseas rewrote the entire spring selling season between a Tuesday and a Saturday. There is a suburb of Milwaukee where 3 competing offers arrive on a Sunday afternoon at the same 6.49% mortgage rate that has Austin frozen solid. There is a Goldman Sachs forecast that just pushed the next Fed rate cut all the way out to June of 2027. with Redfin's own affordability model saying the old normal is not coming back until around 2030. All of it sitting inside one national headline. And underneath that headline, something more specific. A country where the geography of the house you own now decides which side of this standoff you are on. The same market is not the same market everywhere, not even close. The same national headline hides two different Americas. One where the sign in the front yard is a formality, gone in a weekend. One where the sign is a hostage, sitting through spring, then summer, then whatever comes next. Drive into a Milwaukee suburb on a Thursday, and by Sunday afternoon that sign is already down. 3 offers on the kitchen counter, 2 of them above asking. Drive into an Austin subdivision the same week, and the sign that went up in March is still there in June. Same paint, same yard. 2 price cuts deep and quieter every day. Same country, same 6.49% mortgage, same Federal Reserve. 2 completely opposite outcomes. Start with the numbers on the frozen side. In April, roughly 1 in 10 homes listed in Metro Atlanta got pulled off the market without selling, 10.7%, among the highest delisting rates of the 50 biggest American cities, per Redfin. San Jose came in near the top at 9.3%. Los Angeles and Dallas both at 7.8%. Seattle right behind them. You can trace the pattern with your finger. Sunbelt, West Coast, red across the map. In Milwaukee, the typical home sells in about 20 days, according to HomeLight's top agent insights survey. 20. Some neighborhoods still generating offers 6 to 8% over asking. That is not a slowdown. That is a market where buyers are still competing for the same house. Push east from there. In Akron, Ohio, home prices climbed 12% in the first quarter of 2026, among the largest annual increases the National Association of Realtors recorded for any metro in the country. In Providence, Rhode Island, median price per square foot was up 8.7% year-over-year in June, among the biggest gains in America, per Realtor.com. You feel that split in your stomach before you see it in the numbers. 2 sellers this summer, one in an Austin subdivision. Median price per square foot in her metro is down 8.2% from a year ago, and homes take 10 more days to sell than they did last spring, per Realtor.com. Sign in the ground since March. 2 price cuts deep, the showing schedule thinning out. Meanwhile, in a Milwaukee suburb, another seller lists on a Thursday. By Sunday afternoon, 3 offers, 1 all cash, same week, same country. Then there is Memphis, the bleakest number in the whole report. Median listing prices there fell 13% year-over-year in May, among the biggest drops of any of the top 50 metros, per Realtor.com. Nearly 1 in 4 listings carries a price cut flag, 22.3%, waving the white flag. And here is where the story turns. Even with those cuts, sales still fell. Contracts still fell. Pending listings still fell. Cheaper is not bringing them back. Realtor.com's senior economist Jake Krimmel put it plainly. Memphis, he said, looks like a slowing and stagnating market where prices are dropping, not one where lower prices are drawing buyers in. That sentence is the one to sit within this whole story. If price cuts stop working, sellers have lost their last lever. And what a seller is holding in Memphis right now is a house on a street where the next print will be lower than this one, and everybody on both sides of the door knows it. If this reporting is useful to you as you try to make sense of what is happening to the biggest asset most American families will ever own, a quiet like helps it reach the neighbors doing the same math at their own kitchen tables. The divide is not subtle. In the West, list prices have fallen the hardest, down 4% year-over-year in June, per Realtor.com. The South down 2.5%. The Northeast down 1%. The Midwest still flat, still holding. Zoom out further to where prices sit against the 2022 pandemic peak, and the split gets wider still. The West is down 7.3% from that peak. The South down 3.5%, but the Midwest is up 10%. The Northeast up 12.6%. Same country, opposite trajectories, so who is winning right now? Sellers in Milwaukee, in Akron, in Providence, in Richmond, in Worcester. Sellers in Manchester, Nashua, New Hampshire, and Rochester, New York, and South Bend, Indiana. Markets Veros forecasts to grow at least 4% over the next 12 months. Not the pandemic boom cities, the cities the pandemic boom overlooked. Who is losing? Sellers in Austin, in Memphis, in Cape Coral, in Los Angeles, where the median list price sat near $1.1 million in May, and prices still fell 7.9% year over year, per Realtor.com, in Dallas, in Tampa, the exact metros everyone was moving to 3 years ago. The geography of the house you happen to own is now doing more to decide your net worth than any decision you made about it. Which raises the harder question: how does a market flip that fast? How does Austin go from one of the hottest zip codes in America to among the steepest price per square foot declines of any top 50 metro in 3 years flat? What did it in? The answer starts with 4 days in late February. February 24th, 2026, a Tuesday morning. Rate boards at mortgage brokers' offices across the country flipped to a number nobody had seen in almost 4 years. 5.99%, just under 6. For sellers who had been holding on since fall, this was the number they had been waiting for, the one that would end the freeze, the one that would bring buyers back through the front door with checkbooks open. Realtors called their clients, clients called their agents. Homes that had been sitting in a drawer since October were dusted off, restaged, put back on the market. In January alone, tens of thousands of delisted homes had already come roaring back, around 3.6% of all active listings per Redfin. Among the largest January relisting figures in Redfin's records going back to 2016. The would-be spring recovery had a start date, February 24th, and it lasted 4 days. On February 28th, the United States went to war with Iran. You may remember where you were that morning, what that news felt like at the kitchen table. Global fuel supply lines seized up overnight. Bond yields, which lenders use to price mortgages, jumped on inflation fears. The rate that had touched 5.99 on Tuesday was back above 6.5 by the end of that week and climbed as high as 6.75 by May 19th. A Lamakia Realty analyst put it plainly: 4 days after rates landed at 5.99%, Iran happened, and this has changed everything. The entire spring selling season was rewritten between a Tuesday and a Saturday. And it did not stop at rates. Inflation kept climbing. By May, the Consumer Price Index hit a 3-year high of 4.2%, driven partly by the oil shock. Every rate cut Wall Street had been penciling in, 1, maybe 2 by December, got erased in a single week. Goldman Sachs chief U.S. economist David Miracle scrapped the firm's 2026 cuts entirely and pushed the next cut forecast all the way into June of 2027. J.P. Morgan Wealth Management's chief investment strategist Phil Camporeale said the Fed will be on hold for the rest of 2026, full stop. And markets that had been pricing in cuts pivoted in a single week to pricing in hikes, a complete reversal per National Mortgage News. Consider the tens of thousands of sellers who had come back in January, believing this was their moment. Fresh photos of the same house that failed to sell last fall. New price. Days on market counter mercifully reset to 0. Then the rate on that buyer's pre-approval letter climbing 0.5 point in 1 week. The showings dry up. The offer sheet stays empty. The sign in the yard starts collecting pollen. Then something useful happened in the markets that were bleeding worst. Some sellers stopped fighting. The Austin agent, the same one who watched sellers spend last year refusing to yield $1, describes sitting across the kitchen table from those same sellers now. And the sentence she keeps hearing is this: if they sell for less, the next home they buy also costs less. The math works both directions. $100,000 less on the house they are leaving is $100,000 less on the house they are moving into. Once a seller sees that clearly, the standoff inside their own head ends. The agents who can walk a seller through that arithmetic are the ones closing deals right now. The ones who cannot are watching listings age. If your own home lost $50,000 in paper value tomorrow, but the home you had been eyeing across town lost the same 50, would you move? Drop the honest answer in the comments. That single calculation is the hinge the whole market is turning on. Because here is what 4 days in February really did. They did not create the freeze. The freeze was already there, built into every 3% pandemic mortgage and every 2022 price expectation. The war just slammed the door shut on the escape hatch. And that door is still shut month after month with no key in sight until at least the middle of 2027. If rates are the trigger, the trap is the pandemic itself. It never really ended for the American housing market. It just changed shape and got quiet about it. Start with a number that should have fixed everything. Active listings across the country hit about 1.1 million homes in June, per Realtor.com. That is nearly double the roughly 614,000 homes that were on the market in the summer of 2023. On paper, that is a housing market opening back up. More signs in more front yards, more rooms to walk through on a Saturday afternoon, and the market is still stuck. Because 1.1 million is not a lot of homes when you look at what came before the pandemic. It is still 11.3% below the typical 2017 to 2019 level, according to Realtor.com. Inventory is up sharply from the bottom and still short of normal, both things at once. Now hold that alongside the number the buyer is living inside. The typical American homebuyer is spending 37% of their income on housing as of April 2026 per Redfin. The historic norm is 30. Home prices are up roughly 40% since the pandemic began. Your paycheck did not rise 40%. Your grocery bill did. Your insurance did. The National Association of Realtors puts its Housing Affordability Index at 102.3 in June, barely above the line that defines an affordable market at all. Consider what that means for the person on the other side of the front door. A homeowner in her early 50s, bought in 2020, refinanced in 2021 at 3.1%. Her monthly payment is a number she has memorized. To sell that house and buy another one across town at today's 6.49% rate is not a lateral move. On a $400,000 loan, the gap works out to more than $800 a month, every month, for 30 years. That is a new car payment sitting in the driveway that never arrives. That is a year of groceries, every year. So she stays. Multiply her by millions. The Federal Housing Finance Agency's own research estimates the rate lock effect kept roughly 1.3 million home sales from happening between the start of 2022 and the end of 2023 alone. Every one of those non-moves is a chain that never started. A starter home that never opened up because the couple in it could not afford to leave it. That is the rate lock trap. The pandemic-era mortgages are not just cheap money, they are golden handcuffs. Owners who would normally sell for a job, for a divorce, for a downsize, for a school district, are looking at the arithmetic and choosing to stay in a house that no longer fits their life. Supply that should be on the market is sitting in kitchens with coffee cooling on the counter. not listed, not for sale, not moving. And the sellers who did list are often still living in 2022. They watched their neighbors get 3 offers over asking in a weekend. They saw the Zillow estimate climb every month for 2 years. They anchored their price to a market that no longer exists. When the buyer offers $40,000 under, they hear an insult, not a market signal. Meanwhile, the buyer who used to sprint has learned to walk. There is no fear of missing out left in this market. Inventory is rising. Prices are softening in 33 of the top 50 metros, per Realtor.com. Why bid today what you might get for less in October? That wait and see on the buyer side has locked the freeze-in from below. Even the professionals have stepped back. Investor home purchases fell 6% year over year in the first quarter of 2026, the lowest level since 2020. When the bargain hunters do not see bargains, that tells you something about where the buyer pool actually is. And the builders, they are drowning in what they already built. The Census Bureau and HUD put unsold new home inventory near 496,000 units at the end of May. 10.3 months of supply at the current sales pace. Unsold completed inventory at a 16-year high per Resi Club. Last seen at these levels in the wreckage after 2008. Every one of those houses is a builder who guessed demand would show up in 2025. It did not. More listings, frozen owners, cautious buyers, roughly 500,000 spec homes with weeds starting in the landscaping and an interest clock running on each one. That is not a paradox. That is what a standoff looks like from the outside. And a standoff, like everything else in this market, has a clock. The days on market counter is the negotiating position, and it drains a little every night. A seller at the kitchen table at 10 p.m. laptop open, refreshing the listing dashboard the way people used to refresh a stock quote. Day 27, day 40, day 60. The photos have not changed. The price has not changed. The house has not changed. What has changed is what the number itself is telling every buyer who scrolls past it. That this one has been sitting. That something must be wrong with it. That the seller is now the one with the weaker hand. Of the sellers who pulled their signs down last year, waited out the winter, and came back with fresh photos and a reset counter, only 31.6% actually sold per Redfin. Nearly 7 out of 10 still walked away without a buyer. The delist and relist playbook is not a trick that beats the market. It is a delay that costs money. A Redfin agent in Milwaukee has been telling relisting sellers something worth hearing. Buyers can see every price history, every delisting date, every original ask. One click. The reset counter fools nobody. If you delisted at $525,000 last fall after cutting from $550,000, you cannot come back this spring at $550,000 and pretend the buyer has amnesia. The buyer has the record, the seller has the sign, now the number underneath all of it. Existing home sales fell to a 4.09 million annual pace in June. According to the National Association of Realtors, roughly 1.1 million homes a year, below the historic norm of 5.2 million. That is not a slow month. That is a market operating at 4/5 of its normal size, month after month, quarter after quarter. About 1 million transactions a year that used to happen. The moves, the downsizes, the upgrades, the relocations for a new job, that simply are not happening anymore. That million transaction hole ripples further than the housing page. Every home sale carries a tale of spending: movers, painters, appliance stores, real estate commissions, title work, roofers, the furniture bought for the new dining room. The National Association of Realtors estimates each existing home sale generates roughly $125,000 in downstream economic activity. 1 million fewer sales a year is a hole most Americans feel, not through their mortgage, but through their brother-in-law, the electrician whose phone stopped ringing. Consider what that gap looks like on a single street. In Jacksonville, Florida, one home finally sold this year, after the seller cut the price by $100,000 and the listing sat for 67 days. 67 days of showings that led nowhere, $100,000 gone before a signature ever touched paper. That is not a horror story from the bottom of the market. That is roughly what selling looks like now in a lot of the country, which brings the story back to Memphis. Nearly a quarter of the listings there carry a price cut flag. And still, sales are falling, contracts are falling, pending listings are falling, lower prices are not pulling buyers off the sidelines. The buyers looking at Memphis are not seeing a discount. They are seeing a market where the next print will be lower than this one, and they are content to wait for it. The metros with the steepest cuts tell the same story. Median list price per square foot fell in 33 of the top 50 metros in June, per Realtor.com. Austin led the decline at 8.2%, Memphis at 6%, Buffalo at 5.2%. Asking prices nationally were down 2.5% from a year ago, the 8th straight month of declines, and among the steepest annual drops in Realtor.com's records going back to 2017. 8 straight months, not a wobble, a trend hardening into a floor that has not yet been found. And here is the conversation happening at kitchen tables in Austin right now. According to the agent sitting across from those sellers, the enemy is not the buyer. The enemy is the calendar. Sellers who circled back this year, the same sellers who spent last year refusing to yield a dollar, are now agreeing to list at numbers they once called insulting. Not because they lost their nerve, because they ran the math on what another 60 days of silence would cost them. $100,000 off the price of the house they are leaving is $100,000 off the price of the house they are buying next. The seller who finally prices the market is not surrendering. They are the one who did the arithmetic. The ones still living in 2022 are not. The question every seller in the country and every buyer in the country is now asking is the same one. Who blinks first? The forecasters have run the numbers, and the answer is not the one either side was hoping for. Start with the Fed. Goldman Sachs pushed its next rate cut forecast to June of 2027 with a second cut in December. Not this fall, not by Christmas. JP Morgan Wealth Management holds the same view. Fed on hold through the rest of the year. Mid 6% mortgage rates are not a storm to wait out. They are the weather. For at least another 12 months, on a $400,000 house at 6.5%, the monthly payment runs about $1,000 a month higher than at 3%. That is the gap the seller is asking the buyer to swallow. Every month the Fed holds, the gap holds with it. Veros ran the numbers on 300 metros, tracked by National Mortgage News. Among the bleakest projections is Cape Coral, Fort Myers, Florida, down 2.7% over the next 12 months. Austin, Round Rock, Texas, close behind, down 1.7%. If the sign in your front yard is planted in either of those places right now, your listing agent already knows what that means. The house you are trying to sell today is projected to be worth less next summer than it is this one. Now the other end of the same map. Manchester, Nashua, New Hampshire. Rochester, New York, South Bend, Indiana, Rockford, Illinois. Same survey, same 12-month window, forecast to gain at least 4%, same 6.5% mortgage. Two completely different outcomes, decided almost entirely by the zip code on the mailbox, and the entry rung of the ladder is still broken. First-time buyers made up just 33% of purchases in June, per the National Association of Realtors. The historic norm is 40%. The people who are supposed to start the chain, buying the starter home from the couple moving up, who then buy from the empty nesters downsizing, a big chunk of them are not in the room. A chain missing its first link does not move. That is why every seller further up the ladder is also stuck, even in the good markets. Redfin's own affordability model points to the hardest number of all. A return to the old normal, a median earner spending 30% of income on a median home, is not expected until around 2030. 4 more springs of sellers pricing to 2022 and buyers living in 2026. If this reporting has helped you make sense of what is actually happening to the biggest asset most Americans will ever own, subscribing is how you catch the next one. The seller who refuses to cut and the buyer who refuses to raise are both, in their own way, right. The seller remembers a real 2022. The buyer is standing in a real 2026. Neither of them is imagining the market they see. They are just looking at different years through the same window. For any American with a for sale sign in the yard, the honest read is this: the rescue is not coming from the Fed this year. The rescue is not coming from a buyer bailout. It is coming, if at all, from the arithmetic on your own kitchen table, the number you accept on the house you leave against the number you save on the house you buy next. Watch 2 data points in the weeks ahead. The next existing home sales release from the National Association of Realtors, and the next Redfin Delistings report. Between those 2 numbers is the answer to whether American sellers finally start meeting the market, or whether another spring gets buried under the same standoff.